Welcome to Wealthfinity. In today's video, we're going to uncover the unexpected truth behind cash flow investing activities. You may think you know everything there is to know about cash flow, but you might be surprised by what we have to share with you. Whether you're a seasoned investor or just starting out, this information is essential to understand in order to make the most of your investments. So, sit back, relax, and get ready to learn something new as we dive into the world of cash flow investing activities. Let's get started. Cash flows from investing activities refer to the cash inflows and outflows that occur as a result of a company's investments in long-term assets such as property, equipment, and securities. These cash flows can have a significant impact on a company's overall financial health and should be closely monitored by investors. Investing activity cash flow is a key component of a company's overall cash flow statement. It measures the cash that a company generates or uses through its investment activities, such as buying or selling investments or property, plant, and equipment. Understanding investing activity cash flow is important for investors, as it can provide insight into a company's overall financial health and future growth prospects. There are several main sources of cash flows from investing activities, including sale of long-term assets. When a company sells a long-term asset, such as a piece of equipment or a property, it generates cash inflows. These cash inflows can be used to fund other investments or to pay down debt. Purchase of long-term assets. On the other hand, when a company purchases a long-term asset, it generates cash outflows. This can have a negative impact on a company's cash position and should be carefully managed. Conversely, when a company sells long-term assets, it generates cash, which is reflected as a positive cash flow. This can be a good indicator of a company's growth prospects, as companies that are investing in long-term assets are likely looking to expand their operations and increase their revenue. Investment in securities. A company may also generate cash flows from investing activities by purchasing or selling securities such as stocks or bonds. These investments can provide a steady stream of income in the form of dividends or interest payments, but they can also be subject to market fluctuations that can result in gains or losses. The different types of investing activity cash flow and how they can impact your overall financial strategy. The first type of investing activity cash flow is inflow. Inflow is the cash that is coming into your investment portfolio. This can come from a variety of sources such as dividends, interest payments, or capital gains. Inflow is a positive sign for your investment portfolio as it indicates that your assets are generating income. The second type of investing activity cash flow is outflow. Outflow is the cash that is leaving your investment portfolio. This can come from a variety of sources such as stock purchases, bond purchases, or real estate investments. Outflow is a necessary part of any investment strategy as it allows you to diversify your portfolio and potentially earn higher returns. The third type of investing activity cash flow is net cash flow. Net cash flow is the difference between inflow and outflow. A positive net cash flow indicates that your investments are generating more income than you are spending on new investments. A negative net cash flow indicates that you are spending more on new investments than your current investments are generating. When a company buys investments, it uses cash, which is reflected as a negative cash flow in the investing activities section of the cash flow statement. Conversely, when a company sells investments, it generates cash, which is reflected as a positive cash flow. This can be a good indicator of a company's overall financial health, as companies that are buying investments are likely generating enough cash to invest in other opportunities. Financing activities. Some companies may also generate cash flows from investing activities through financing activities such as issuing or repurchasing shares of stock or issuing bonds. These activities can raise capital for the company, but they can also result in increased debt or dilution of existing shareholders' ownership. Investing activity cash flow can also be affected by other factors such as change in working capital and short-term investments. This can include changes in accounts receivable, accounts payable, and inventory. A positive change in working capital, for example, would mean that a company has generated more cash from its operations than it has used to pay its bills. A negative change, on the other hand, would mean that the company has used more cash than it has generated. Overall, cash flows from investing activities are an important aspect of a company's financial health. Investors should closely monitor these cash flows to gain insight into a company's ability to generate cash, fund growth, and manage risk. It is important to note that all of these activities will be reported on a company's cash flow statement, which is a financial statement that shows the cash inflows and outflows for a specific period of time. This statement is useful for investors and analysts to understand a company's liquidity and solvency. Cash flows from investing activities are a key factor in determining a company's financial health and stability. By monitoring these cash flows, investors can gain insight into a company's ability to generate cash, fund growth, and manage risk. It measures the cash generated or used through investment activities such as buying or selling long-term assets and investments. By understanding investing activity cash flow, investors can gain insight into a company's overall financial health and future growth prospects. It is important for investors to keep an eye on the investing activity cash flow of a company they are considering investing in, as it can provide valuable information about the company's ability to generate cash and invest in growth opportunities. In conclusion, the video discussed the unexpected truth behind cash flows from investing activities. It was highlighted that cash flows from investing activities can provide insight into a company's growth strategy and financial health. Understanding the sources and uses of cash from investing activities can help investors make more informed decisions when evaluating a company's potential for long-term growth. Overall, cash flow analysis is a powerful tool for understanding a company's financial performance and potential for future growth.